Hi everyone, and welcome to KingsCrowd's first ever course demonstration in startup investing. My name is Olivia Strobel, and I'm an investment associate with the KingsCrowd team. We understand that investing in startups can be a daunting task, and we hope that this demonstration helps. We will start with the basics of what is a startup and work our way through market size, business models, and more. By the end of this course, you should feel fully confident in investing in this asset class. Before we dig into startup investing, it is important to outline what exactly constitutes a startup, and the answer is not as straightforward as it may seem. In fact, there is no exact definition. If you don't believe me, here are some definitions from experts. But for the purposes of this course, we will define a startup as an early-stage company actively raising funding, characterized by rapid growth or high risk. Of course, this is a very broad definition. In fact, some people still consider companies like Uber to be a startup. If you are unfamiliar with startups and startup culture, we recommend checking out this NPR podcast where Guy Raz interviews founders of companies that were once or still are considered startups, some of which you are likely to be very familiar with. But remember, this podcast highlights clear success stories, and building a startup is risky. You will very rarely hear a founder suggest that the entrepreneurial journey was easy. As early-stage companies that are often pre-product, startups typically need capital to get off the ground. Granted, not all startups raise. Some bootstrap, some don't ever raise capital. But for those who do, you may be wondering, where do they get this money? Startups receive money in rounds. These rounds, sizes, and timing are not set in stone, but are a general rule of thumb when it comes to funding. The earliest rounds are typically funded by individual investors. Angel investing typically refers to accredited investors or high net worth individuals that are actively funding startups. Equity crowdfunding can technically include these individuals, but also allows the general public to invest with as little as $50. Venture funding is a later stage and typically comes from venture firms like A16Z or Sequoia. Other forms of funding include grants, which typically are not in exchange for a percentage of the company. At this point, you may be wondering why you should invest in startups. As I mentioned, there is potential for seriously high returns. And when we say high returns, we really mean it. You may be familiar with Coinbase. If not, Coinbase is a digital currency wallet and platform where merchants and consumers can transact with new digital currencies like Bitcoin, Ethereum, and Litecoin. Coinbase is now 8 years old, has over 30 million users, has traded over $150 billion, and has over $547 million in funding from prominent venture capital. Coinbase raised first funding via equity crowdfunding on Funders Club. Just 8 years later, Coinbase is among the largest fintech companies of 2020 with an $8.1 billion valuation. Outside of potential for high returns, startup investing allows for impressive differentiation in any investment portfolio. Startup investing as a whole should be a very tiny portion of an overall portfolio, maybe 10% of your investment budget, but you can diversify across stages and industry within this sector. In addition to these investments, you may want to choose to invest in other, less risky asset classes, like stocks, real estate, bonds, and cash equivalents. And finally, investing in startups is a great way to get in at the ground floor with underrepresented founders, as well as causes that you might care about. Before we invest, it is important to make sure that you are compliant with SEC regulations. But don't worry, thanks to the Jobs Act of 2012, you no longer have to have above a certain income level to make these investments. First, it is important to identify yourself as either an accredited or non-accredited investor. In short, an accredited investor is someone who meets one or more special requirements. The general definition you often see for accredited investors includes certain individuals that earn an income exceeding $200,000 per year, or $300,000 with a spouse in each of the prior 2 years. Such individuals are expected to do the same for the current year or have a net worth over $1 million. This may be achieved either alone or together with a spouse, excluding the value of the person's primary residence. Assuming you now know where you fall when it comes to investor type, you may be wondering what this means for you. But similar to investors, not all deals are the same. It is not only investor type, but deal type that determines how much and where you can invest. Regulation CF is short for regulation crowdfunding. This is a 12-month offering with a limit of $1.07 million. This is likely to change in 2021 with updated SEC regulations making the cap $5 million. Other limitations are listed on the slides. Regulation A+ has a limit of $20 million for Tier 1 and $50 million for Tier 2. There are no investor limits for Tier 1, and non-accredited are subject to limits for Tier 2. Solicitation here is permitted with guidelines. Finally, Regulation D 506C is limited to accredited investors with documented verification. For Regulation D, there is also no investor limit. This may seem complicated, but don't worry. Each platform where startup deals are listed will have easy tools to help you stay in line with regulations. For example, say you as an individual have $100,000 in net worth and make $75,000 in income per year. This automatic calculator provided by WeFunder tells you exactly how much you can invest in each regulation type. Notice that the tool automatically labels this example as a non-accredited investor and sets Regulation D deals as off limits. So how exactly can we see returns on these investments? There are 3 types of exits that are popular in this asset class. IPO is short for initial public offering and is synonymous with a listing on a stock market. Another exit opportunity is what is called an acquisition. This is when one company buys up another company. For example, when Facebook acquired Instagram for $1 billion. Finally, mergers occur when 2 companies come together to create one larger company. This is similar to an acquisition, but both companies rebrand as one entity. But what if you don't want to wait for an exit, or if one seems to never come? Platforms like Forge are available for trading pre-IPO shares of companies that remain privately held. Often, these shares come from employees or early investors wishing to trade when they otherwise could not. Examples of such companies include DoorDash and Impossible Foods, now in Series H and Series E rounds of funding. Now that we've discussed the similarities and differences between startup investing and other more traditional asset classes, it is important to get an overview of the different security types offered within the space. This is especially important given that some of these security types may sound familiar, but others are unique to the asset class and were created for the purposes of private equity crowdfunding. The first security type that falls in the category of being unique to the asset class is the SAFE, or Simple Agreement for Future Equity. This is also one of the most common security types you will see in the space. It lends itself very nicely to the startup investing space because, as the name suggests, it allows investors to hold stake in future equity of a young company. The future stake is triggered by a financing event like those mentioned in the last module. Next, we have common stock or equity. This may sound familiar. Common stock simply refers to the ownership of shares or stake in the company. This is not dependent on a triggering event like the SAFE. Preferred stock, another security type, is essentially the same as common stock, but includes some added benefits for the investors. These could include, but are not limited to, guaranteed dividends, flexibility to convert equity to common equity, as well as liquidation preference, meaning that in the case of a liquidation, owners have priority over common stockholders. Up next is the convertible or crowd note. The convertible note is the equivalent of a short-term loan that converts into equity at a milestone or maturity date, often, like the SAFE, at a specific financing event. Notes are tied to what are known as valuation caps, which limit the price at which the notes convert to equity. We will dive more in depth into valuation in later modules. Another security type that may look familiar is the traditional debt deal. These deals pay investors back on a loan with additional interest according to a regular payback schedule. The revenue share loan is yet another security type, this time linked to the company's financial performance. Payments back to the investor are thus varied and put to use often by companies with uncertain cash flow. Finally, you have membership units, which are unique to limited liability companies, entitling investors to a share in the company's net annual income, in addition to voting rights, typically on major company decisions. Each of these security types can be grouped into 2 categories, equity deals and non-equity deals, or debt deals, which hopefully simplifies your understanding. The crowdfunding space can be confusing. There are a number of security types. plus some niche others that we won't get into. But in general, all fall into one of these two categories. At this point, you are probably still wondering how to actually put your money into these startups. You may not personally know any founders or any other angel investors, and this is a very new space. So up next, we are going to break down the crowdfunding ecosystem. Despite being young, the startup investing ecosystem is by no means small. Recall the different crowdfunding types from earlier modules. In 2019, $137 million were raised via Regulation CF raises, and $2.4 billion and $4 billion for Reg A Plus and Reg D, respectively. This money was raised on what are called crowdfunding platforms. Think of them like the different stock exchanges, though on a much smaller scale. They list companies looking to raise money. Here are some examples of popular companies that have raised money via private equity crowdfunding and the platforms on which they listed their raise. Now let's break down some of the major platforms, beginning with regulation crowdfunding raises. StartEngine, WeFunder, Republic, NetCapital, and MicroVentures are, in that order, responsible for the most successful raises. Each of these platforms are pretty inclusive when it comes to deal flow. You can find a wide range of industries and stages of various offerings. These are a few of the big platforms in the space, but there are a few others you should know about, and some of these others have more niche focuses. Fundana, for example, hosts only deals related to the CBD and cannabis space. Mainvest hosts primarily debt and revenue share deals. And SeedInvest, another big name in the space, hosts plenty of Regulation A+ deals in addition to their regulation crowdfunding offerings. In short, no platform is created equal. Each has advantages and disadvantages, but each of these that we touched on in this module are reputable and secure. Outside of the platforms, there is one other part of the ecosystem that we want to address: research and aggregators. This is where KingsCrowd comes in. Let's return to our stock market analogy. If you think of the platforms like WeFunder and NetCapital as the different stock exchanges, you can think of KingsCrowd as Morningstar or Bloomberg, a trusted source for research and recommendations, as well as a one-stop shop for all the active raises across platforms. Now that you're familiar with the different platforms, we can break down an individual company raise page. For the purposes of this course, I pulled KingsCrowd's raise page. Most raise pages are going to have a section on terms of the deal. Here you can see when the KingsCrowd deal closed, the most recent unit price, the original unit price, and the total raised. This is also where most companies will list valuation. Up next, the raise page is likely going to list the problem that the startup is trying to tackle. For example, KingsCrowd's problem: addressing the online private markets with data tools. Following the problem section, the startup is likely going to show you their solution to the problem that they've identified. Here you can see a breakdown of the KingsCrowd solution to the problem that we addressed. Up next, the startup is likely going to list their key team members as well as their accomplishments. Here you can see some of the major team members associated with the KingsCrowd platform. The raise page will also likely list competition. At this time, KingsCrowd has no direct competitors in the space, but many other companies will, and this is where they would be listed. The business model is also likely to be on the raise page. This will include whether the company plans to sell directly to consumers, to other businesses, or through other businesses to consumers. This is where the company will also likely list pricing for their product. Finally, there's likely to be a section on traction. This is where companies might list their current customers, especially if they're B2B services. Additionally, you can always check the financials of a company, which are often listed on the raise page or can be found through the SEC website. As investment researchers at KingsCrowd, we like to break our ratings into something that roughly mirrors the raise page. First, we like to look at market size. Market size can be split into three categories: total addressable market, serviceable addressable market, and serviceable obtainable market. We define the total addressable market as how big the largest possible market is in which the startup exists. The serviceable addressable market is what proportion of that market we think realistically fits the startup. And finally, obtainable market is that which we believe that this startup can actually reach. We use sources like Grandview Research to check out these market sizes. Here is an example of the US footwear market size. Where the total addressable market might be the global footwear market size, a startup operating in the US that creates, say, athletic shoes might have a serviceable addressable market of US footwear. This could be split into athletic and non-athletic footwear, making the serviceable obtainable market only a fraction of this total market size. Finally, when tackling the market, we like to look at the CAGR, or compound annual growth rate, of the market as a whole. This is often applied to the total addressable market to see how rapidly growing the market is. Generally speaking, the larger the market, the better, and the larger the CAGR, the better. We always like to see markets that are growing at a higher rate, as startups that exist in this space are likely to yield high returns. Up next, our analysts check out the terms of the deal. These are available on every raise page, as mentioned before. First, we like to look at the valuation cap. Again, generally speaking, a lower valuation cap is better. We also like to look at the total discount. The discount is applied to that valuation cap, so the higher the discount, the better deal you're getting. Next is the minimum investment. The minimum investment is more of a personal preference as to whether or not you would like to, say, invest $50 or $100 as a minimum in a startup. In the terms of the deal, the security type will also be listed, as well as the funding goal and when that raise is going to close. We also love to look at the founding team, especially with early stage companies. The founding team frequently carries the team's potential. Some considerations that our investment team members make are the total number of founders, the total number of team members, the relevant industry experience that the founder might possess, any prior exits that the founder might have under their belt, whether or not the company has any notable investors or advisors, the founder's educational background, which includes the number of unique universities, as that expands the networks for potential investors, as well as the founder's age. On the KingsCrowd website, we provide you with founder profiles, where you can get a better look into who a founder is. In the founder profiles, we interview each founder, asking them things like what their business model is like and what inspired them. Up next is the company's business model. Our analysts consider the revenue model when taking into account the overall business model. These models could include transactional models, recurring models, or advertising models. Others may be licensing or franchising. Next, we look at the company's margins. These are often reported on the raise page. Generally speaking, you want higher margins to yield a higher return on investment. Next, we look at distribution type. As mentioned before, this could be business to business, business to consumer, business to government, or business to consumer through another business. Finally, we like to look at the business type. We split our business types into 3 categories: lifestyle, growth, and high growth. High growth are those likely to see huge returns in the future and grow at a rapid speed, whereas growth companies might be a little bit slower. Lifestyle companies generally consist of family businesses, restaurants, and other food and debt deals. Competitive differentiation is another massive indicator of whether or not a company has high return on investment potential. Some considerations that our analysts make when looking at a competitive differentiation score are the quality differentiation, the price differentiation, the number of direct competitors, and that includes whether or not the company is a first mover or last mover, and the status of the competitors. For example, are they large incumbents or smaller startups? Take Uber and Lyft, for example. Uber definitely had a first mover advantage, but Lyft still came onto the scene very hot. Performance and traction is another great indicator of a company's future success. One great resource for this is Crunchbase, a comprehensive startup listing. Here you can see the Coinbase listing on the Crunchbase site. On the Coinbase profile, you can see that they have raised $547 million in total funding. Obviously, Coinbase is very established, and many of the startups we see on these platforms are going to have much less prior funding. You can also see the number of investors, the number of total investments, and the current team members. Finally, you can check out a Form C. This is on Disclosure Quest via the SEC website. Each company that raises on one of these platforms is required to file a Form C. On the annual report disclosure requirements, you can see short-term debt, long-term debt, cash and cash equivalents, as well as revenue and much, much more. A lot of these financials factor in to whether or not we decide a company is worthy of investment. Hopefully now you have a better understanding of the online private markets. But what's next? Here are some insider tips. First, invest in what you know. Second, you can always track your investments with the KingsCrowd portfolio tool. Third, keep track of your favorite founders and companies on Twitter and Facebook. You can also check out secondary trading platforms on StartEngine and NetCapital. These are platforms where you can trade shares of these companies before they IPO, similar to Forge, which we spoke about earlier on in the modules. Next, sign up for the KingsCrowd newsletter to stay up to date on all things online private equity. You can also join the KingsCrowd Insiders Facebook page for alerts on top deals, polls, and more. This is, of course, for paying customers only. Finally, get to know the services offered by KingsCrowd. Thanks, and happy investing.